please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
An important market again which we will track is also the rupee market. Yesterday closing at 66.91, that clearly indicated that 14-month low that the rupee touched because of dollar strength and of course Indian macro fears as well. To discuss both the Indian macros and more importantly the global macro with US yields touching 3.03, Jahangir Aziz of JP Morgan joins us on the phone line from New York. Good evening to you, Jahangir. Thank you very much for staying up for us. Well, first, the global setup from your perch in New York itself. For 2 or 3 days, or maybe just 2 days, the equity markets dithered and worried over the 3% mark, and then they rose on the strength of earnings. So should we conclude that growth will prevail over inflation and interest rate fears?
Look, I mean, the reaction in the bond market, I think, was repricing of bond, market to the fact that given what's happening to growth and given what's happening to inflation in the U.S., the likely scenario is that the Fed funds rate are going to move closer to where the midpoints are as projected by the Fed, rather than what the market was pricing. And I think that, it's also a greater appreciation of the fact that growth in the U.S., both in 2018 and 19, will be run by a much larger fiscal deficit, 1.5 to 2 percentage points of GDP of higher fiscal deficit, which should be accompanied by a much wider current account deficit. And I think that what is happening in the market is just maybe a late appreciation of these pressures, but I think it's just a repricing of what the macroeconomics has been saying for quite some time.
Jahangir, hi, good morning from India. But the higher 10-year yields do imply that borrowing costs are climbing, right? Does this mean that it would become more expensive for, corporates to deliver earnings going ahead unless they, commensurately increase their own growth?
Look, I mean, if you look at, as the person was saying, just before we were speaking, the corporate earnings has been reasonably strong. None of these factors have actually driven corporate earnings because they're backward looking. Looking forward, I think, if you look at where growth is projected to be in the U.S., we have somewhere around 2.3, 2.4 for 2018, and we have about 1.8 with no major increases in wage pressures. I think the profit cycle, even with the 10-year yield rising a bit more, we have 325 for the end of the year. I don't think it's going to put pressure on the profit cycle at this point in time.
Oh, that's that's the kind of analysis we were wanting to hear. What happens if 325 is hit? Because some technical analysts were expecting that as well. Will there be any other kind of problem, Jahangir, if 3.25 is hit? Any other credit bubbles or something?
Look, I mean, that's what we have been expecting from the beginning of the year, just based on the macroeconomic drivers in the U.S. economy. I think what has been the new spanner in the works is trade tensions. And again, that's where the biggest uncertainty is, at this point in time. It isn't so much, where the 10-year is going to go, but much more has to do with, where does trade with U.S., China is actually going to lead to. Yeah.
Okay, should we worry about ourselves then? If 3.25 is hit and... No, I mean, we've seen the dollar strengthen. Until now, the rising yields were not accompanied by dollar strengthening, but now that has happened. The dollar has come up to 91.2. So, should we worry? We are already at 67.91. Should we worry for?
Right. So the two parts of the question. One is that, look, this is a repricing that's happened. My sense is that, once the repricing is done, we will reach a more stable equilibrium, so to speak, in the bond market in the U.S. But the Indian situation, which is rising yields and depreciating rupee, is driven by India's own macroeconomics. If India is going to see rising fiscal deficit and rising current account deficit, then it is natural to see yields rising as well as the rupee depreciating. And, you know, the band-aids that have been put forward by the RBI, both in terms of playing around with the issuance calendar or with extending forbearance to banks, those are just band-aids. You know, they lasted for 2-3 trading sessions and they disappeared because they were going against the fundamentals of this economy, which is a 2018-19 story of rising fiscal deficit and rising current account deficit. You can play around. I mean, you can try to stop that from surfacing into prices for some time, but you know you really cannot go against fundamentals for a very long period of time.
So, just to summarize it, then, Jahangir, is the case getting a bit stronger for the RBI to raise rates anytime soon because of the macro situation?
I'm somewhat confused at this point in time, and my confusion comes from the fact that you know the RBI has multiple objectives. Trade-off in one hand. It is also the debt manager of the government. It is also the keeper of financial stability in the economy.
Okay.
At this point in time, it is unclear whether monetary policy is being targeted for inflation, or is being targeted for the 10-year rate, or is being targeted to keep financial stability. You know, Lata, you and I have had this discussion in the
had
past,
fights, yes.
And you know, you came up with the argument, if it ain't broke, why fix it? Okay. But I think if you go back and take a look at both, Governor Subbarao's statements in the past, the Sri Krishna Committee report as late as 2016-17, you will notice that there is a tremendous amount of emphasis given in separation of these three objectives.
Okay.
You know, in normal times, these three objectives do not collide. At this point in time, it is colliding.
All right. Well, Jahangir, we'll have to take the debate on another day on Indianomics. But thank you very much indeed for joining us.